Have you ever wondered if a 19% dividend yield is too good to be true? Today, we're exposing the biggest mistake investors make when evaluating high-yield stocks, one that could be costing you thousands. Most people treat dividends like savings account interest, but that's completely wrong, and I'll prove it. Stick around because by the end of this video, you'll know whether this 19% yield is a goldmine or a dangerous trap. The biggest mistake I see investors making when looking at a company's dividend yield is twofold. The first is to wrongly compare it to a savings account where you receive interest and the principal value doesn't change. An investment in the stock market never carries a steady principal value. It moves up and down with the demand of the market. One day, you may have $100 of value. The next, you may have $105, and the day after, you may have $90. The second mistake compounds the first. They assume that when a dividend is paid, that value is extracted from the company. Assuming the value is $100 and you receive $1, they assume that the value of the company is immediately reduced to 99. While exchanges will adjust to the opening price down on the night of the ex-dividend date, the value of the company rapidly changes throughout the next day. Therefore, when someone says, well, you've lost value because of the dividend paid to you, they have a fundamental misunderstanding of how the stock market works. They're attacking a straw man of their own making. This isn't a bond or a savings account where that interest is paid and the principal remains stagnant. This is a stock investment where the value will change based on supply and demand. And the dividend is cash you receive into your account that has a set value at that point. Your equity position in the company does not reduce with the dividends you've been paid. The number of shares you own remains stagnant, and now you've only received cash. I like to refer to this as income. You don't lose a portion of your job every time you get a paycheck. You have the same job, and you've received income from the work that you've done. This misunderstanding can be expanded to various investments within the market. Today, I want to look at an investment that offers an eye-popping 19% yield and evaluate the recent earnings to see whether this is a value trap, a fake yield, or a massive income opportunity. Let's dive in. Eagle Point Credit Co., ticker symbol ECC, yielding 19.2%, is a closed-end fund that invests in credit instruments. Primarily, ECC focuses on various levels of the capital stack within a collateralized loan obligation, or CLO. ECC has historically focused on owning the highest risk and highest reward position, the equity tranche, but ECC has historically also been adaptable to owning various debt tranches with lower yields, but significantly less risk. ECC isn't done growing yet, growing its CLO equity portfolio by $183 million. This follows growth of $141 million in the third quarter. Year over year, ECC has grown its CLO equity position from $632 million at the end of 2023 to $1.1 billion at the end of 2024. This growth has been funded through issuing equity, issuing new baby bonds like ECCU, issuing preferred stock, and retaining cash flow. Additionally, ECC built up a substantial position in CLO debt in 2023 when disruption in the debt markets caused yield to maturities to get well into the double digits. ECC's management saw an opportunity to get equity-like returns from debt, and they took it. Today, most of that debt is trading close to par, and ECC has been selling it as a source of cash to buy more CLO equity. At the end of the quarter, ECC was 78.8% in CLO equity and 7.5% in CLO debt. If we compare that to the end of 2023, we can see this is a significant shift, as at the end of 2023, ECC was 69.4% in CLO equity and 15.5% in debt. Based on management commentary, we expect that this trend will continue. They expect to sell off their debt investments near par as they source attractive opportunities to invest in CLO equity. This will result in higher cash flow, since equity positions produce a lot more cash flow than debt positions. Additionally, ECC has been very active in resetting and refinancing CLOs in its portfolio. Resetting a CLO means that the equity holders call all of the outstanding debt, replacing it with new debt under a completely new deal. Refinancing is when the reinvestment period and other terms are left the same, but the debt is called and replaced with new debt. The reason ECC is doing this is because spreads have tightened for CLO debt. Both actions result in lower interest expense for the CLO, and that means more cash flow for the CLO equity positions that ECC holds. The bottom line is that CLO equity is producing gobs and gobs of cash flow. Management is taking steps to ensure their investments are producing more cash flow while also growing the overall portfolio. The market freaked out last quarter, causing ECC to trade at the lowest premium to NAV in over a year. ECC was trading at a premium relative to peer OXLC. I'm very happy to be adding more ECC at these low prices and collecting gobs and gobs of cash flow. The market continues to heavily discount wonderful income opportunities, heavily because the focus of the market is not on collecting income. The market continually looking elsewhere instead of on wonderful income investments allows millions of income investors and myself to benefit from this lack of attention. Similarly, your retirement can massively benefit from even a small amount of exposure to ECC. With its double-digit yields and cash flow covering the dividend successfully, you can not only receive 19% yields throughout the rest of the year from ECC, but can also receive it in the future. Going forward, the yield of ECC won't always be 19%. It may go up or it may go down. The value of the shares will change, but at the end of the day, the income you receive isn't reducing the value of what you own. It's simply the cash flow from it coming into your account. That's the beauty of dividend investing.